Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is David Garofalo, the chairman and CEO of Gold Royalty. David, great to see you.
Great to see you too. Thanks for having me on.
Well, it's an absolute pleasure having you on. David, you're about 90% gold, so we can tell you're very bullish on gold. What factors will impact gold's performance in the future?
Well, I think it's interest rates lower for longer, quantitative easing. Tapering is a relative term. I've heard that they're tapering, but they're still buying. They're still buying government bonds. They're still buying corporate bonds. They're going to continue to do that for the foreseeable future. They're going to continue to debase their currency because ultimately all of the debt they've strapped on both pre and post pandemic is really not fiscally sustainable. It can't be repaid from tax revenues. I think the only way to deal with debt is to basically debase the debt and debase the underlying currency to do that. So fiat currency will continue to expand in supply, and gold is the one currency you can't print.
Mm-hmm. Yeah, it's this tapering that they're doing, a lot of people are wondering whether or not it's for real, whether it's sustainable, whether the market's going to flip out and just have a crisis, a taper tantrum, as they call it. I know you're in Canada, but you obviously watch what's going on in the United States and what the Fed does very closely. How do you think the market's likely to respond as we taper?
Well, I think we're in the beginning of an inflationary cycle, no matter what they do on the tapering side. And again, I said tapering is a relative term. I think it's still going to be expanding money supply, it's just going to expand at a slower rate. But they're going to continue to print fiat currencies to deal with their debt situation. They're going to print their way out of debt. That's the only way to deal with the amount of debt that they've strapped on. But what's really alarming, and you bring up Canada, but I would say in the Western world generally, it's a coordinated effort from all the central banks in the Western world to debase their currencies on a competitive basis to maintain their export markets. So if the US continues to print money, Canada will, Europe will, and the Asian economies will continue to base their currencies as well. So it's a competitive debasement. Paper is infinite, and gold and commodities are finite. And so the prices of those will continue to go up. We're going to continue to experience double-digit inflation for the foreseeable future. That's what we have now. Don't believe the headline CPI numbers. They vastly understate the inflation we're all experiencing. Yeah, inflation is 6 or 7% unless you're eating or putting fuel in your car or buying a house. Otherwise, it's like 30%.
Do they fake the CPI in Canada also? Is it massaged like it is here to artificially low?
It is everywhere.
Yeah,
it is everywhere. It's ridiculous, and it really understates what we all have to pay just to live, to breathe. And that's unfortunate. But I think the reality is that we're seeing that in inflation in equity prices. If you look at the multiples we're seeing in general equity markets, they've been distorted beyond recognition. And that's because there's so much paper chasing a finite number of businesses and hard assets. So everything's inflating, commodities inflating, copper's at all-time highs. Bitcoin is a bubble, and in my view, in cryptocurrencies, that's just reflecting the reality that a new class of investors are looking for ways to preserve their capital, safeguard their capital. They're mistakenly looking at cryptocurrencies as a scarce commodity that will protect their capital. Well, the reality is it's just zeros and ones. Any moron can create a digital currency, in my view, and undermine.
Many morons have created them.
So I'm just saying that there are all sorts of signs and flags about the inflation that we're experiencing in every aspect of our economy. Yeah. But gold is so finite in quantity, ultimately it'll explode in value.
Well, you told me also beforehand that you have a thesis on silver also as it relates to gold. Could you share that with our audience?
Well, look, the way I look at silver is it's a proxy for gold and tends to provide a much higher leverage to increasing precious metal prices. And the way I look at it is in a bull market, when gold's really flying, typically the gold to silver price ratio goes down to as low as 40 to 1 or less. And right now it's more like 70 or 80 to 1 because, gold has been range bound. It's kind of lost its luster. It's waiting for the next leg up. But when it does achieve that momentum, if you believe gold is going to 3,000, which is my thesis, that would be the all-time high in real dollars. Mm-hmm. Silver is going to go to north of $100 an ounce.
Yeah.
in that environment, because it's going to overperform or outperform gold because of that leverage opportunity that I talked about, that ratio starting to narrow as the gold price gains some momentum.
David, do you think the current inflation rate is warning us of a crisis ahead, and how will that affect the precious metal space?
Yeah, look, I think inflation is rearing its ugly head. People are concerned that interest rates are going to start to go up. But I look back at the last massive inflationary cycle we had as an economy, which was in the 1970s. And gold didn't achieve its peak until 1981, which was $850 an ounce, which was 2 years or so into the tightening cycle. Remember, Paul Volcker came in to run the Federal Reserve, and he was the inflation hawk that started to rein in money supply, bring up interest rates. And it was 2 years after he started doing that we actually started to see peak gold. And that was, again, the real all-time high for gold. $850 an ounce in 1981 is $3,000 an ounce today. I didn't just pull that 3,000 target out of my hat. I just looked at the all-time real high. We haven't come close to achieving that. So even if the Federal Reserve starts to taper, the damage is done, and it takes a number of years for that damage to undo itself. And we won't see peak gold until a couple of years into that tightening cycle, in my view, peak gold pricing, I should say.
Do you really think they can tighten with the amount of debt they have? I mean, it just seems implausible to a lot of people that with 30 trillion in debt and 3 trillion deficits and the housing bubble where it's at and just the everything bubble where it's at, I question whether they can even taper and fully stop their buying of bonds, let alone raise interest rates. I mean, where do you think that line is that we'll get to? All the way up to, you think we'll actually get to the point of tapering being complete and then raising rates?
I think it's unlikely, and I certainly don't think rates are going to go up on a real basis. They may go up marginally on a nominal basis, but at that point, inflation will be very, very high, and real rates will continue to decline. That's what you need to look at, not the nominal number. What's the real number net of inflation? And that will continue to go down and continue to stay in negative territory. We're decidedly in negative territory now. We're going to be further negative territory even as nominal rates start to go up. And that's really what happened in 1981 is, yes, Paul Volcker was raising the benchmark rate, but inflation was still galloping away and real rates were coming down. That's why the gold price was going up. That's what's going to happen in this cycle, in my view.
Gotcha. Do you think we even have a Paul Volcker in the central bank system now, though? It seems like that personality has been purged entirely from the system, don't you think? All the PhDs running around?
No, I haven't seen anybody rear his head and talk about inflation. They seem to be united in singing from the same choir book on the Federal Reserve Board. So we'll see. But no, I haven't seen any evidence of that kind of personality yet.
Well, the other thing that I've noticed is they seem to be acknowledging there's inflation, but they all want to blame it on supply chain disruptions or COVID. No one seems to want to say, oh, maybe we shouldn't be printing, $3 trillion a year, or whatever the number is now. They don't seem to want to think monetary policy has anything to do with it, right?
No, and this is unlike the inflation cycle back in the 70s. This is very much a money supply driven inflation cycle. Back in the 70s was oil. Oil was really the reserve currency of the world. Our economies ran on oil, and OPEC, launched an embargo, and that infected the entire supply chain because the economy ran on oil to a much larger degree than it does today. This is being driven by money supply. Mm-hmm. And I feel like the central banks pay more attention to the level of the equity markets than they do to actually taming inflation. They want to keep that party going for as long as possible. I think ultimately that's going to end in tears.
David, do you think Powell just wants to get it over with and retire and just throw it on the next guy?
Well, I think to a degree, every one of them want to do that. They want to get it while the coin's good.
Get out and hit the speaking circuit, right?
Yeah. Will we start seeing stagflation in 2022? What's your thoughts on that?
Yeah, I mean, that's a real risk, and we certainly saw that in the 70s. Inflation eats away at capital, it eats away at productivity. It really infects the economy and ultimately causes significant unemployment, causes slower growth. I mean, it's a real concern. ultimately we're going to end up into that type of cycle for sure. And again, in that type of environment, you want to protect your capital. And I'd say gold is where you want to be, precious metals. And there's a very finite quantity of it. And when you want to preserve your capital, you want to do that with a hard asset that can't be replicated or produced at a whim. And there's so much inelasticity of supply to price in our industry because of the capital intensity, the social barriers to building new mines. It's a very, very difficult industry to ramp up and respond to the gold price. We can't just make more gold overnight. It takes sometimes decades to bring new mine capacity on. It certainly takes a lot of exploration effort, a lot of capital intensity, a lot of engineering, and a lot of social engagement with surrounding communities and governments and regulators and whatnot. It's a very, very difficult industry to ramp up supply in.
Well, that raises the point. You follow the gold mining industry closely as part of Gold Royalty Corp. Are you seeing that trend that it's tougher and tougher to, like the big mines, as they are depleted, it's tougher and tougher to replace them with those tier one, 500,000 ounce a year in the lowest quartile, or that thing that like Barrick, Mark Bristow likes to define as a tier one. And Barrick itself, Mark Bristow, he seems to be shifting more towards copper than gold. He wants to make, one of the largest gold mining companies more of a copper play going forward. Is that because they're having a tougher time finding those big tier one assets now?
Yeah, absolutely. And I'm not just a royalty guy. I mean, up until I launched Gold Royalty back in March in an IPO, I spent over 30 years building and operating mines. I ran Goldcorp, I ran Hudbay, I was the CFO at Agnico Eagle for 12 years, 8 years at Inmat. So I've been a mine builder my entire career. It's never been more difficult to replace depleting reserves and resources. In fact, gold reserves in the industry are down 40% since their peak 7 years ago because of underinvestment in exploration and mine development. The industry's been so focused on deleveraging their balance sheets, returning capital to shareholders. The reality is they've not cycled back any capital back into the ground to replace depleting reserves. And so, yes, it's becoming extremely challenging. I'm not surprised that Mark's looking to diversify because he recognizes how precious metals are, how scarce they are, how difficult they are to find. And so the only way to grow, if you're not finding it, is to buy it. And he's looking to diversify, obviously, because he recognizes how scarce these resources are and how difficult they are to find and ultimately develop into productive mines.
David, how big is the upside for the miners? Like, I know we're talking about lots about miners, but how big is the upside? People
that's a good question. We think the upside for the underlying commodity is X. How much more leverage do you think the gold miners will have this cycle?
Honestly, there's a reason after 30 years I've gone into the royalty business, and it's because I think that the leverage proposition in gold miners is going to be undermined by significant input cost inflation. And we're at an interesting point in the cycle where there's been a significant amount of underinvestment in the industry and new mine capacity. Reserves are depleting, production is depleting. That undermines that leverage proposition, but also because there's going to be a catch up in investment in new mine capacity, companies are going to have to spend more in exploration, more in mine development to replace that depleting reserve and production base. It's going to drive up input cost inflation. And also, we're seeing inflation in the general economy that will further amplify that. And so we've been there before. If I look 10 years ago when we came out of the credit crisis, and I was running Hudbay Minerals at the time, I was building a big copper mine in Peru called Constancia, and I was building a couple of other gold mines in northern Manitoba called Lawlor and Reed. And I have to tell you, at that time, there was massive cost inflation because everybody was building new mines, both on the base and precious side. But at that time, we didn't have inflation in the general economy. We had 1% to 2% inflation. Now we have that rush to build new mine capacity, and we have inflation in the general economy. That will erode margins in the gold industry, even if and as the gold price goes up. So if we look at what happened to gold equities back then, well, during that cycle when gold went from $1,000 to $1,900 an ounce post the credit crisis, so gold went up 140%. We saw the mining equities actually go up only about 65 or 70%. They underperformed the commodity. You know what happened to the royalties and streamers? they went up almost fourfold. They went up almost 400% as the
Really?
gold price went up 140%. The simple reason is they provide you top line exposure. They provide you leverage to the gold price and leverage to exploration success, because the royalties are typically not only on the existing deposit, but any growth geologically in them. And so they provided that optimum leverage with zero exposure to input cost inflation, because it's all on the top line. We're in that type of cycle again. I think that's what's going to happen. So I think gold is going to fly. Again, my thesis is gold goes up at least 50% from here, but I don't think the mining equities are going to keep pace. I think they're going to underperform, and we've seen that underperformance in the last year. We've seen a steady degradation in valuations in the mining industry over the last year because of the fear of inflation and narrowing margins. And I think the royalty companies are going to vastly outperform in that market.
That's a good point. In fact, I've heard Keith Neumeyer in a previous interview I had with him, he said something along the same lines, that there's two things that could cause silver to skyrocket. There's the monetary inflation, monetary debasement portion that could cause it to go up. And then there's the shortage side, physical supply shortage that could cause it to go up. Well, if it was only a physical shortage proposition, then the margins get really good. But if it's a monetary debasement issue, yeah, as you just described, the margins, the margins shrink because your cost inputs go up. He thinks it's actually, we're in a situation where both are going to happen at the same time, and so we've never had that before. And so it's going to be really interesting as to how this plays out over the next 10 years. But I know Keith was mentioning something very much along the same lines as you.
Well, Keith's a friend, and I actually have a royalty on his mine, Jarrett Canyon. So,
oh, nice.
So you're why it's Jarrett Canyon so high cost, right?
Oh, that's good. How long does it take on average to set up like a silver or gold mine? Like I know a lot of people think, oh, next week you can just set one up, but on average, is it 2 years, 5 years? How long would it take?
I would say it could be multiple decades, from discovery to first production. That's true for both silver, gold mines. In fact, it's true for any major mine, because, typically you're spending a long time geologically delineating and drilling out the deposit to know what you have and making the economic case, engineering it, raising the necessary capital. Quite often you're spending hundreds of millions to billions of dollars to build a new mine. And also what's a big impediment now is getting local communities to support it, getting permits from regulators within the country to operate. We often don't find deposits in the most politically amenable countries. They tend to be in more difficult parts of the world that are underdeveloped and don't have a regulatory regime that's rational and systematic and timely and predictable. And so, like I said, there's a remarkable elasticity of supply to price in the mining industry generally. We just can't flick on new capacity tomorrow in response to a higher price. It is a big lag between higher prices and higher supply.
Well, David, I really want to thank you for giving us some of your time and sharing your expertise with our audience. We'd love to talk to you again in the coming months as this market develops this year and next year.
Well, thank you for having me on. It was a real pleasure.